We're diving into an article from the Motley Fool that really caught my eye.
Oh, yeah.
Yeah, they're praising this company, Mid-America Apartment Communities,
Yeah.
MAA,
Got it.
as like the dividend stock to watch for 2025 and beyond.
Wow.
They're really going out on a limb claiming it's going to outperform even in a tough market. So we're going to unpack their reasoning and see if MAA could be a good fit.
Okay. Interesting.
For your portfolio.
What I find fascinating is they're basing this on more than just MAA's past performance.
Right.
Though it is impressive.
Yeah.
They've never cut or suspended dividends in 30 years.
30 years. That's incredible.
REITs can't boast that kind of consistency, especially in real estate.
Yeah, most of us weren't even born yet when they started this streak. What's the secret sauce? How have they managed to keep those dividends flowing for so long?
Well, part of it is their strategic focus on the Sunbelt region.
Right.
It's been experiencing tremendous growth. People and companies moving in, boosting demand for rentals.
Yeah, for sure.
But that's not the whole story.
Okay.
Because even in a growing market, you have to be smart about managing your business.
Right.
And MAA doesn't just sit back and collect rent checks.
Yeah.
They're actively making moves to adapt to the market.
Okay, so they're not just riding the Sunbelt wave. They're actually paddling hard.
Yeah.
What kind of moves are we talking about?
Well, for one, they're not shying away from new developments, even with interest rates being what they are.
Yeah.
They have 5 projects already in the lease-up phase.
Oh, wow.
That means tenants are signing leases and getting ready to move in.
So lease-up phase is like the final stretch before a building starts generating full income.
Exactly. Like the home stretch of a marathon.
Got it.
They're building for the future. Banking on that 2025 turning point, the Motley Fool keeps mentioning, when demand is supposed to really take off.
It's a bold strategy.
Right.
But couldn't that backfire if those predictions are wrong?
Right.
I mean, the real estate market can be pretty unpredictable.
For sure.
What if the Sunbelt boom fizzles out?
That's the million-dollar question, isn't it?
Yeah.
And that's where understanding their financial health comes in.
Okay.
We need to dive deeper to see if they can weather a potential storm. But the fact that they're not only building new, but also investing in existing properties is a good sign.
Okay, so they're renovating.
Upgrading.
Things like renovations, amenity upgrades, you know, those state-of-the-art gyms and fancy common areas.
Yeah. Who doesn't love a good apartment gym?
Exactly.
But how does that translate into profits for MAA?
Well, those upgrades let them charge higher rents,
Okay.
increase the property value, which in turn attracts investors and keeps those dividends flowing.
Right.
And speaking of dividends,
Yeah.
MAA's current yield is over 3.5%.
Wow.
That's more than triple the S&P 500 average,
Triple the average. That's huge.
which is languishing near a 20-year low.
So even if the market takes a dip, their dividend history suggests they'll find a way to keep those payments coming.
Exactly. It's a powerful track record that gives investors a sense of security.
But remember, past performance doesn't guarantee future results.
Right, of course.
We need to look at the full picture.
Okay.
And that includes their financial stability, which we'll unpack in the next part of our deep dive.
Okay, so we've got a company with a history of solid dividends making bold moves in a growing market.
Uh-huh.
But we need to make sure their financial house is in order before getting too excited.
Yeah, that's important.
Stick around for part 2, where we'll crunch some numbers and see if MAA's financials are as impressive as their dividend history.
Sounds good.
Okay, so we've established that MAA has this killer dividend history
Right.
and this bold growth strategy.
Uh-huh.
But now it's time to roll up our sleeves and see what's happening under the hood. Let's look at those financials.
Yeah, diving into the numbers can feel a bit like opening Pandora's box sometimes.
Right.
But it is crucial for understanding whether a company's actions are truly translating into financial strength.
So where do we even start? What are the key things we should be looking for when we're trying to get a sense of their financial health?
Well, one place to start is revenue growth.
Okay.
Is the company making more money year over year?
Right.
That usually indicates their business model is working.
Yeah.
And they're attracting more customers, or in MAA's case, more tenants.
So is MAA's revenue growing? Are those new developments and property upgrades paying off?
Well, it's not quite that simple.
Oh.
Remember we talked about the current state of the apartment market?
Yeah.
It's been a bit of a roller coaster.
Right.
With all that post-pandemic construction putting pressure on rent growth,
Yeah.
MAA has seen some revenue growth, but it hasn't been a straight shot up.
So external factors are definitely playing a role here.
Yes.
But even with those challenges, they're still investing heavily in growth.
Yeah.
Shouldn't we see that reflected in their financials eventually?
That's where it gets interesting.
Okay.
To understand the full picture, We need to look beyond just that top-line revenue number.
Right.
And consider their expenses as well.
Right, because making money is great. But if you're spending even more, that's not a recipe for success.
Right.
What are some of the big expenses a company like MAA has to deal with?
Well, there's the obvious stuff like property management,
Right.
maintenance, and even marketing to attract new tenants.
Okay.
Then there are things like property taxes, insurance, and, of course, any debt they're carrying.
Debt, that's always a big one.
Yeah.
If they're borrowing a ton of money to finance all these new projects,
Yeah.
couldn't that put them in a risky position?
It certainly could. That's why it's so important to look at their debt levels
Okay.
in relation to their assets and overall revenue.
Yeah.
Are they taking on a manageable amount of debt, or are they getting over-leveraged?
Over-leveraged.
Yeah.
That sounds like a bad thing.
Yeah.
Basically like using too much credit and not being able to make the payments.
That's a good way to put it.
Okay.
And that's why we also need to assess their profitability.
All
Are
right.
they actually making money?
Yeah.
After all those expenses and debt payments are factored in.
That's the ultimate goal, right?
Oh, that's it.
To have money left over at the end of the day. How do we measure that?
That's where we look at something called net income,
Okay.
which is essentially their profit after all expenses are subtracted from their revenue.
Got it.
We want to see consistent profitability
Okay.
and ideally growth in their net income over time.
So you've got revenue, expenses, debt, and net income. Sounds like a lot to juggle.
Yeah.
But I'm guessing it's not just about looking at these numbers in isolation, right?
You're absolutely right. It's about understanding the relationships between them
Okay.
and seeing how they work together to tell us a story about MAA's financial health.
Okay, so how do we do that? What are some of the tools or metrics that help us connect the dots?
Well, one important metric is the net income margin.
Okay.
This tells us what percentage of their revenue actually flows down to profit.
Okay.
A higher margin generally means the company is more profitable
Got it.
and efficient.
So 20% net income margin means for every dollar of revenue, they're keeping 20 cents as profit.
Exactly. And then there's return on equity, or ROE,
Okay.
which measures how efficiently they're using their shareholders' money to
Yeah.
generate profits. A higher ROE indicates they're doing a good job putting those investor dollars to work.
Okay, so we're looking at margins and returns. Starting to feel like a real financial analyst here. But I have to admit, it's easy to get lost in all these numbers and ratios.
I hear you. It can be a bit overwhelming at first.
Yeah.
But remember, we're trying to get a feel for the overall picture, not become accounting wizards.
Right.
So let's focus on some key takeaways when it comes to MAA's financials.
Okay, so what should we be focusing on? What's the big picture story here?
Well, firstly, don't forget that their financial performance is influenced by those external factors we discussed earlier,
Right.
those market conditions
Yeah.
that are putting pressure on the entire apartment industry.
Yeah, for sure.
So don't be alarmed if their revenue growth or profit margins aren't setting off fireworks.
Right. It's all about context. What else should we keep in mind?
Well, remember all those investments they're making in new developments and property upgrades.
Right.
Those can definitely impact their bottom line in the short term, even if they lead to stronger performance in the long run.
So they're playing the long game,
Exactly.
which requires us to look beyond just the current numbers.
Yes, it's about asking the right questions.
Okay.
Are they managing their debt responsibly?
Uh-huh.
Are they controlling their expenses?
Okay.
Are those investments likely to pay off down the road?
So while we're looking for signs of financial strength, we also need to consider their strategic decisions and the potential for future growth.
Precisely. And while MAA's financials might not be screaming, buy me now,
Okay.
they certainly don't paint a picture of a company in distress.
Right.
They seem to be navigating these choppy waters carefully
Okay.
while still positioning themselves for that predicted market upswing in 2025.
So no red flags flashing,
Yeah.
but also not a guaranteed home run just yet.
Yeah.
We need to factor in those risks and opportunities, right?
Absolutely. And that's what we'll explore in the final part of our deep dive. We'll look at the potential risks and rewards of investing in MAA, and we'll even compare them to other options in the real estate sector.
Okay, sounds like we've got a lot more ground to cover. Stick around for part 3, where we'll wrap up our deep dive into MAA and see if this dividend darling is worth adding to your portfolio. Okay, so we've explored MAA's impressive dividend track record and their bold growth strategy, and even dug into their financials. But before we jump to any conclusions,
Yeah.
we need to talk about the bigger picture. What are the potential risks and rewards of investing in MAA? And what other options are out there in the real estate world?
You're right. No investment is without risk.
Right.
And MAA is no exception.
Okay.
As we've discussed, their fate is closely tied to the performance of the apartment market.
Yeah.
Especially in the Sun Belt.
Okay.
So any economic hiccups or unexpected shifts in that region
Right.
could impact their occupancy rates and ultimately their bottom line.
So even though the Sun Belt is booming right now, there's no guarantee it will stay that way forever.
Exactly. And while the Motley Fool is predicting a turning point in 2025,
Right.
where demand will outpace supply,
Okay.
it's worth remembering that the real estate market is famously cyclical.
Oh, yeah, for sure.
Those predictions could be off,
Yeah.
leaving investors exposed.
That's a good point.
Mm-hmm.
It's easy to get caught up in the hype and forget that even the experts can get it wrong sometimes.
And here's another thing to consider. We talked about how rising interest rates are cooling down the building boom,
Right.
which is ultimately good news for MAA.
Uh-huh.
But those higher rates also make it more expensive for them to finance their own growth through debt.
I see what you mean. It's a double-edged sword.
Uh-huh.
Higher rates could benefit them in the long run,
Yes.
but create some financial strain in the short term.
Precisely. And on that note, it's important to acknowledge that MAA is a pretty big company.
Okay.
They're worth over $19 billion,
Wow.
which can sometimes make it harder for them to be nimble and
Yeah.
adapt quickly to changing market conditions.
So their size, which seems like a strength at first glance,
Uh-huh.
could actually become a bit of a liability in a fast-moving market.
Exactly. They might not be able to seize those smaller niche opportunities that a smaller company could.
Right.
Plus, they face competition from other large REITs,
Sure.
private developers,
Yeah.
even individual landlords. The apartment market is a crowded space.
Okay, so we've got a company that's heavily reliant on one region,
Mm-hmm.
facing potential market volatility, navigating rising interest rates,
Mm-hmm.
and competing in a crowded market. With all these risks, why would anyone even consider investing in MAA?
That's the million-dollar question, isn't it?
Yeah.
And the answer lies in weighing those risks against the potential rewards.
Right.
Because despite the challenges, MAA has a lot going for it.
Okay.
First and foremost, there's that incredible 30-year track record of consistent dividend payments.
Right.
That's a huge draw for investors seeking a reliable income stream.
That's true.
Yeah.
Knowing those dividends have kept flowing through thick and thin is definitely reassuring.
And remember their growth strategy. While ambitious is aligned with the predicted growth trends in the Sun Belt,
Okay.
if those trends continue,
Yeah.
they're well positioned to capitalize on the increasing demand for rental housing.
So they're betting big on the continued success of that region.
They are. And don't forget about their commitment to property upgrades.
Right.
By investing in their existing portfolio and adding those high-end amenities, they can attract higher-paying tenants
Right.
and potentially increase their occupancy rates, even in a competitive market.
It's like they're trying to create those resort-style living experiences that people are willing to pay a premium for.
Exactly. And while their size may have some drawbacks,
Yeah.
it also gives them certain advantages.
Like what?
They have economies of scale that smaller competitors lack.
Okay.
They can negotiate better deals with suppliers,
Uh-huh.
spread their marketing costs over a larger portfolio,
Okay.
and access more favorable financing terms.
So their size can be both a blessing and a curse, depending on how you look at it.
Exactly. At the end of the day, the decision of whether to invest in MAA comes down to each individual investor.
Right.
You need to consider your own investment goals,
Uh-huh.
your risk tolerance, and your overall investment strategy.
And that's why it's so important to do your own research and understand the full picture,
Exactly.
which is what we've tried to do in this deep dive.
We've laid out the information, highlighted the key factors to consider,
Right.
and hopefully given you the tools to make an informed decision.
But even if MAA isn't the perfect fit for your portfolio,
Yeah,
it's always wise to explore different options and compare them side by side.
absolutely.
So let's talk about some other ways investors can gain exposure to the real estate market.
Mm-hmm.
What are some alternatives to investing in individual REITs like MAA?
Well, you could look into other types of REITs.
Okay.
Remember, MAA focuses on apartments.
Right.
But there are REITs that specialize in everything from shopping malls and office buildings to warehouses and healthcare facilities.
So you could diversify your real estate holdings by investing in REITs that focus on different property types.
Exactly. That way you're not putting all your eggs in one basket, so to speak.
Right.
And if you're comfortable with a more hands-on approach,
Yeah.
you could always invest directly in physical property.
That sounds a bit more involved than just buying shares of a REIT. What does that entail?
It means buying a rental property, a commercial building,
Okay.
or even a piece of land.
Okay.
But being a landlord comes with its own set of responsibilities.
Right.
You have to find tenants, manage the property, deal with repairs and maintenance. It's not for everyone.
Yeah, I think I'll stick to my low-maintenance REITs for now.
Fair enough.
Yeah.
But for those with the time and inclination, direct property ownership can offer a different level of control and potentially higher returns.
It's all about finding the right balance between risk-reward and effort.
Absolutely. And if you're looking for something in between,
Okay.
there are also real estate mutual funds and exchange-traded funds, or ETFs.
Okay.
These funds invest in a basket of REITs or real estate companies, giving investors instant diversification without having to pick and choose individual stocks.
So it's like a one-stop shop for real estate exposure.
Yeah.
And it sounds like a good option for those who want to dip their toes into real estate without getting too deep into the weeds.
That's a great way to put it. And there are even newer options popping up.
Oh, really?
Like crowdfunding platforms
that
allow investors to pool their money and invest in larger real estate projects.
Wow.
It's a way to access deals that were previously only available to big institutional investors.
Wow. That seems like there are more ways to invest in real estate than I ever realized.
There are. And the key is to do your homework.
Right.
Understand the risks and potential rewards of each option, and choose investments that align with your individual goals and circumstances.
Well said. I think we've given our listeners a lot to think about in this deep dive into MAA and the wider world of real estate investing.
Yeah.
We've explored the company's strengths, their weaknesses,
Yes.
the potential risks and rewards,
Right.
and even offered some alternative investment strategies to consider.
It's been a fascinating journey.
It has.
And hopefully our listeners feel empowered to make more informed decisions about their own investment portfolios.
Me too. So as we wrap up, I want to leave our listeners with one final thought. Investing is a marathon, not a sprint. It's about building a diversified portfolio that aligns with your goals,
Yeah.
your risk tolerance, and your time horizon.
And having the patience and discipline to stick with it, even when the market throws you a curveball.
Couldn't agree more. Well, that's all the time we have for today's deep dive. We hope you found this information valuable and thought-provoking.
Yes.
And remember, the journey to financial literacy is an ongoing one. Keep learning, keep exploring, and never stop asking questions.
Until next time, happy investing.